Venture capital is a high-stakes, high-variance industry where performance is everything. But how does a VC firm measure success? How do limited partners decide which funds to back? And how can general partners ensure they're delivering competitive returns? The answer lies in benchmarking, the process of comparing a VC fund's performance against peers, industry standards, and historical trends. For LPs, benchmarking provides crucial context for evaluating a fund's success relative to the broader venture landscape. For GPs, it helps ensure they remain competitive, refine investment strategies, and position themselves as top-tier investors. In an industry where capital is flowing to the best-performing funds, firms that understand how to benchmark effectively will have a clear edge in fundraising, deal-making, and long-term sustainability. In venture capital, success is always measured in relative terms. LPs, GPs, and even founders don't just look at absolute returns, they compare a fund's performance against peers to make better investment decisions. Benchmarking is at the core of how capital is allocated, strategies are refined, and reputations are built. For LPs, benchmarking serves as a capital allocation tool. They don't just assess a fund's IRR in isolation, they evaluate how it stacks up against other funds in the same vintage year, investment strategy, and geography. A 20% IRR might seem strong, but if peer funds are averaging 30%, LPs may hesitate to reinvest in a firm that isn't keeping pace with the market. Performance is always relative, and underperforming funds risk losing institutional backers to stronger competitors. For GPs, benchmarking is a critical tool for self-assessment and strategy improvement. It forces VC firms to ask the hard questions. Are we outperforming or lagging? Are we taking on too much or too little risk? How do our valuations, follow-on strategies, and exit timelines compare to industry norms? Without clear performance comparisons, funds risk making decisions in isolation, missing key market trends that could shape their long-term returns. Even founders look at benchmarks when choosing their investors. The most promising startups want to partner with VCs that demonstrate strong performance, high-value exits, and the ability to support them through multiple funding rounds. A firm with below average returns and slow exits will struggle to win competitive deals. Ultimately, benchmarking isn't just about measuring success, it's about staying competitive. It shapes everything from LP fundraising to deal sourcing to portfolio management. The firms that track their performance against the best in the industry are the ones that consistently refine their strategies, attract top founders, and maintain strong LP relationships. In a world where capital flows to the best performing funds, staying ahead of the curve is not optional, it's essential. Venture capital is a long-term game, and measuring fund performance requires more than just looking at returns. LPs, GPs, and industry analysts rely on standardized benchmarks to evaluate how a fund is performing compared to its peers. These metrics determine whether a VC firm is excelling, underperforming, or simply keeping pace with the market. At the fund level, investors track key performance indicators like IRR, TVPI, DPI, RVPI, and MOIC. These metrics provide comprehensive insights. IRR for annualized returns, TVPI for total realized and unrealized gains relative to capital invested, DPI for actual cash returned to investors, RVPI for assessing unrealized portfolio value, and MOIC for measuring the overall multiple of invested capital. Beyond individual fund performance, industry benchmarking plays a crucial role. Funds are compared based on vintage year, ensuring they are evaluated against peers that faced similar market conditions. They are also assessed against strategy peers. Early stage, growth stage, and sector-specific funds have very different return profiles. Geography also matters, as US, European, and Asian VC ecosystems vary in terms of exit opportunities, deal flow, and risk tolerance. Finally, exit and liquidity metrics reveal whether a fund can convert paper gains into actual returns. Time to liquidity tracks how long portfolio companies take to exit, while exit multiples measure how much capital was generated from IPOs, acquisitions, or secondary sales. The percentage of write-offs provides insight into the level of risk in a portfolio. Strong funds minimize failed investments and maximize high-return deals. For LPs, Benchmarking isn't just about tracking numbers, it's about identifying which funds consistently deliver strong results. The best performing VCs attract more capital, win competitive deals, and secure their place in future fund cycles. Those who fall behind risk being overlooked in an increasingly data-driven investment landscape. Unlike public markets, venture capital lacks real-time, transparent data on fund performance. Unlike stocks and bonds, where market prices provide immediate feedback, VC fund performance is only revealed over time. However, investors rely on several key sources to benchmark their funds against industry standards. Institutional benchmarking databases provide some of the most widely used performance insights. Cambridge Associates is one of the go-to sources, offering deep analysis on VC and private equity returns. PitchBook delivers fund-level data, exit trends, and deal flow insights, while Preaching tracks global fundraising activity and LP commitments, helping investors understand how capital flows across different funds and regions. Beyond third-party databases, LP-generated benchmarking reports serve as another critical data source. Large institutional investors, such as university endowments and pension funds, regularly publish reports comparing the performance of their VC allocations. Additionally, sovereign wealth funds often provide insights into sectoral and geographic investment trends, offering a macro-level perspective on VC markets. Lastly, many firms rely on proprietary data from their own investment history. Leading VCs track internal performance metrics and compare them against peer funds to refine their strategies. Some firms even use AI-driven analytics to model how their portfolios stack up against the broader venture ecosystem, leveraging data science to predict trends and optimize deal flow. For VC firms, access to strong benchmarking data provides a competitive edge. It helps them position their funds more effectively, attract LP commitments, and make better-informed investment decisions in an industry where past performance is often a key indicator of future fundraising success. General partners rely on benchmarking not just to assess past performance, but to refine investment strategies, strengthen fundraising efforts, and anticipate market trends. By comparing their fund's performance against peers, they can identify key areas for improvement and make more informed decisions. One critical use of benchmarking is in refining investment and portfolio construction strategies. If a fund is underperforming in key metrics like TVPI, the total value to paid-in, or IRR, the internal rate of return, GPs may adjust their follow-on investment strategies or reallocate capital more effectively across different stages. High write-off rates compared to similar funds could signal the need for better due diligence, improved founder support, or a shift in investment focus. Benchmarking also plays a key role in managing LP expectations during fundraising. A firm that consistently outperforms its peers can justify raising a larger next fund or charging higher fees. On the other hand, if a firm is underperforming, being transparent about how it compares to others helps manage LP concerns and demonstrates an improvement plan, rather than leaving investors in the dark. Another advantage of benchmarking is spotting market trends early. Comparing sector-wide trends allows firms to see whether certain industries, such as deep tech, SaaS, or fintech, are emerging as stronger investment opportunities. Additionally, if other funds from the same vintage year are showing higher DPI but distributed to paid-in, while a firm's liquidity is lagging, it may signal a need to adjust exit strategies or portfolio rebalancing. Top-tier VCs don't just use benchmarking as a retrospective tool. They leverage it to refine investment decisions, ensure alignment with LP expectations, and stay ahead of market shifts that define long-term fund success. The venture capital industry is moving toward greater transparency and real-time data tracking, reshaping how firms benchmark performance and communicate with investors. One of the biggest advancements in this space is the adoption of AI-powered fund analytics. More firms are integrating AI and predictive modeling to track fund performance in real time relative to their peers. This technology allows VCs to identify risks, valuation trends, and liquidity opportunities before they become critical issues, providing LPs with more accurate forecasting and decision-making support. Another major shift is blockchain and tokenization for performance tracking. Decentralized finance, or DeFi, and tokenized funds could enable real-time visibility into fund net asset value, exits, and liquidity. Instead of waiting for quarterly reports, LPs may soon have dashboard access to monitor fund performance as it happens, increasing trust and reducing friction in fund management. As VC becomes increasingly institutionalized, standardized performance benchmarks are also expected to emerge. More structured reporting frameworks will allow LPs to compare funds more easily, creating industry-wide benchmarks that promote greater transparency and accountability. Ultimately, the future of benchmarking in venture capital is about enhancing visibility, improving decision-making, and strengthening LP relationships through better data. Firms that embrace these innovations will gain a competitive edge in fundraising and fund management. The most successful venture capital firms don't just focus on absolute returns, they ensure they are consistently outperforming their peers and industry standards. Winning in VC requires more than just making great investments. The best general partners consistently track fund performance metrics like IRR, DPI, TVPI, RVPI, and MOIC, ensuring their results stand out. They compare their performance against similar funds by vintage year, geography, and investment stage, leveraging data-driven insights to refine their investment strategies and positioning with LPs. Firms that embrace tools like AI and predictive analytics gain an advantage by improving decision-making and implementing real-time performance tracking to enhance transparency with LPs. In venture capital, success is not only about making money, but also about consistently outperforming competitors. Firms that benchmark effectively will build deeper trust with LPs, attract better deals, and secure capital for future funds.